Why the Federal Reserve controls so much of the economy? You can see this at the top of any US $1 bill. That's because despite the bill's origin from the Treasury, the people that really distribute it are the Federal Reserve. They bear the responsibility of overseeing the currency in use within our financial system. To put it another way, they have the ability to create money. In 2020, it became a trending meme as the Fed was inventing money on the spot. The Federal Reserve is responsible for the US economy in numerous ways. According to a former chairman, they're the guardian of the economy who's placed the order to take the punch bowl out right before the celebration became quite heated. Thus, people are aware of their choices, similar to increasing interest rates that aren't always well liked. The Fed is simply so misunderstood, yet it is a very significant institution in our nation. It's critical that people understand what is happening with the economy. They ought to comprehend the purpose of the Fed, the reason behind its actions, and the part it plays in the nation. So allow me to clarify. How did the Fed become the punching bag? The formation of the Fed, as far as we are aware, has changed over time. Following reactions to financial crises, the Fed was handed increasing amounts of authority. So let's begin by discussing the rationale behind the Fed's creation. First of all, early in the 20th century, bank runs were not uncommon. If a bank or other private company failed, that implied all deposits were lost. People would flee to their banks out of fear, rushing to take their money out. Banks alone did not carry that much cash on hand, so if they failed, more people would run in dread to the bank they used. Additionally, these banks had nowhere to go to obtain additional funding to halt these runs. After the big run of 1907, rich bankers such as J.P. Morgan contributed their own funds to essentially provide for them. Following that panic of 1907, leaders in business and politics gathered and said, perhaps there are other ways to manage a contemporary economy than this, relying on a small number of well-off people acting morally amid a critical moment. Thus, talks on setting up a central bank began, which developed into the Federal Reserve System. The Federal Reserve was established in 1913 with the goal of becoming the central banking system in the United States, a bank for banks, essentially. There are 12 distinct Federal Reserve banks established throughout the entire nation. There was still a great deal of mistrust in the country that rather than just one bank, the Fed might be too strong. The theory went, you might travel to various regions of the nation and remark, well, New York won't have the power. It will be here, not in Washington. Atlanta will have a bank. In Kansas City, a bank will be present. A bank each will be located in Minneapolis and San Francisco. Additionally, there are two in Missouri. A senator from Missouri played a crucial role in the Federal Reserve System's establishment. And sure enough, a Federal Reserve Bank appeared in Kansas City and St. Louis. The plan was for them to each stand in for various sections of the nation, autonomously establishing their own guidelines. The money bank's interest rates would remain the same. Every bank was assigned a president as well. The formation of the FOMC. The Great Depression then struck. Historians generally agree that the Federal Reserve Bank's operational measures and their maintaining the flow of currency and financing too restrictively exacerbated the Depression. Almost a century later, a governor of the Fed declared, "We did it." Issues existed prior to the Great Depression. The required political concession had made the Fed too decentralized. In reality, nobody was in charge. Consequently, Congress placed the Board of Governors in Washington. There would be 7 people in the group from various regions of the nation, including a chairman, each confirmed by the Senate after the president nominated them, similar to a Supreme Court justice. These banks are under the Federal Reserve System's supervision, and they are members of the Federal Open Market Committee, FOMC. The FOMC includes 5 presidents of banks, 4 rotating and 1 from New York. This group congregates and determines matters such as interest rates. When discussing a Fed meeting, you are referring to an FOMC meeting. The terms start to be used interchangeably because the FOMC engages in specific activities. The Fed board engages in specific activities, and they all seem to merge into one another. High inflation. Thus, that's how we arrived at the Fed's fundamental framework. However, the Fed, as it exists today with all of its obligations, was constructed as a reaction to additional financial disasters. First, let's discuss inflation in the 1970s. Additionally, in 1978, Congress granted the Fed, or actually the FOMC, 2 major priorities. The Fed was tasked with 2 mandates: maintaining price stability and full employment. Now, occasionally, those objectives clash. When attempting to combat inflation, you will sometimes take actions that result in unemployment increasing. Although the directive really stated the Fed ought to consider both of these goals when they establish guidelines. This was a result of the 1970s inflation, commonly known as the Great Inflation, caused by a confluence of unfortunate events and poor policies. Inflation rose to about 15%. There were worries that the Fed might give in to political pressure in the early 1970s since Arthur Burns, the Fed's chair at the time, was cordial with the president. Nixon was against increasing interest rates before his 1972 re-election. Thus, the entire Great Inflation experience strengthened the notion that central banking ought to be politically independent. In general, when you avoid politics in the FOMC boardroom, your economic results are superior. President Jimmy Carter in 1979 appointed Paul Volcker as the Fed's head, and he significantly increased interest rates to around 20%. The unemployment rate surged and surpassed 10%, and the Fed came under fire. 2x4s would be mailed by home builders saying to the Fed, "Stop these oppressive interest rates." They would mail the Fed the keys to their homes and cars with a note, "These are homes and cars that aren't being sold." Some tractor drivers protested, cruising around the Fed's main office. History has supported the Volcker Fed's actions. He is now revered as the person who took action that was really difficult and controversial. However, if you examine the U.S. economy in the 30 years that ensued, it did better compared to the majority of other wealthy economies. The Great Downturn. The Fed became more reputable due to its political independence, since excellent economic policies are not often produced by politics. And when the financial crisis of 2008 struck, Ben Bernanke, the chairman of the Fed, gained knowledge from earlier experiences. The audacious actions the Fed adopted as a reaction to the current financial crisis partially represented its resolve not to repeat the same kinds of errors it committed both prior to and during the 30s Great Depression. Among those audacious actions, the Fed for the first time dropped interest rates to almost zero. Apart from overseeing the currency and distribution, as well as sporadic treasury security, it began lending large sums of money to non-banking institutions. It entered new markets as well, purchasing products such as mortgage securities, all to stimulate the economy financially. This increased the Fed's involvement inside the financial system beyond interest rates and currencies alone. One of the reasons Bernanke was highly respected was because he threw everything at the wall to observe what would endure. He took care to prevent it from getting worse. It's known as the Great Recession, and certainly not the Great Depression EU. Congress also granted the Fed additional power regarding supervision and control over the financial industry, both by way of dodd-frank and just the default of inaction. Following the 2009 stimulus, government spending decreased. There was also a saying that the Fed had turned into the sole competition in town. If your economy needed stimulation, you weren't going to increase spending or reduce taxes because Congress was opposed to doing so. Finally, what transpired was that financial markets intensified and started clinging to every syllable in all of the Fed chair's statements. Monetary policy became so crucial at this point to the markets, as well as to the nation's economic prospects. That includes as inflation increases. To further these objectives today, the FOMC hiked the policy interest rate by 1/4 percentage point. The Federal Reserve was established in reaction to an economic downturn, and its influence has only grown with every crisis that has followed. Nevertheless, not without occasional criticism. Some still say it's time to terminate the Federal Reserve. The Federal Reserve remains mostly a bank for banks, but it's now also a stopgap for the majority of other financial system components. It can act swiftly without causing political repercussions. To the extent that there are a few non-elected officials making important economic decisions, it's something the White House and Congress, our elected officials, have decided over several decades to contract with the Fed on. If you found this content helpful, be sure to like the video. Subscribe for more insightful articles and updates. And don't forget to leave a comment below with your thoughts or any questions you may have. We'd love to hear from you.